Welcome to The Explainer. Today, we're peeling back the layers on what is arguably one of the most powerful tools in modern finance, the exchange-traded fund. I mean, imagine just being able to buy a slice of an entire economy, or, a whole technology sector with just a single click. That's the fundamental promise of the ETF. It's a financial innovation that has absolutely reshaped how both massive, heavyweight institutions and everyday people like us interact with the global markets. Let's get into it. Here's our roadmap for today. We're going to cover understanding exchange-traded funds, exploring types of ETFs, comparing investment vehicles, how ETF creation works, and finally, pros, cons, and investing. Let's kick things off with part 1, understanding exchange-traded funds. So, at its absolute core, an ETF pools a group of securities into a single fund. But here's the real game changer. It allows you to buy and sell this entire pooled group throughout the trading day as market prices fluctuate. It works exactly as if you were trading shares of a single company. You don't actually own the underlying securities yourself, though. Instead, you buy a share of the fund, and the fund itself owns the assets. To picture this, just think of an ETF like a giant piggy bank. But instead of just tossing pennies in there, this bank holds a massive variety of different assets. We're talking dozens, maybe even hundreds of different stocks, bonds, or commodities, all jammed in together. By owning a piece of that piggy bank, you get instant exposure to everything inside it. It's literally immediate diversification wrapped up in one very accessible package. And to really wrap our heads around the sheer scale of this invention, well, consider this. In the United States alone, a staggering $10.2 trillion is currently invested in equity ETFs. Plus, add another $2.4 trillion in fixed income ETFs on top of that. Globally, these numbers are just swelling, with hundreds of billions parked across Europe and the Asia-Pacific regions. It's become a totally dominant force. I mean, ETFs now account for roughly 1/3 of the total dollar volume of stock market trading in the US. That is huge. So, how do we get here? The concept actually first popped up back in 1990 on the Toronto Stock Exchange, with participation units tracking the Toronto 35 index. But the real turning point hit in 1993. That's when State Street Global Advisors launched the SPDR S&P 500 ETF. You probably know it by its super famous ticker symbol, SPY. It's the oldest and most well-known ETF in the US. And from those pretty humble beginnings, this vehicle has evolved chronologically to embrace incredibly complex modern assets. We saw the approval of Bitcoin futures ETFs in 2021, and then those landmark SEC approvals of spot Bitcoin and spot Ethereum ETFs in 2024. Moving right along to Section 2, exploring types of ETFs. The ETF structure is just incredibly versatile. Of course, you've got your passive ETFs that perfectly replicate a broad index like the S&P 500, but then you also have actively managed ETFs where portfolio managers are in there making specific buying and selling decisions. Though, keep in mind, those do come with higher fees. Then there are bond ETFs giving you regular income without a set maturity date. You can also target highly specific areas with industry or sector ETFs like tech or energy. You can even buy commodity ETFs that hold physical assets like gold bars, which, let's be real, is way cheaper than trying to store actual gold in your house. And obviously there are currency and cryptocurrency ETFs that give you direct exposure to exchange rates and digital assets right from your standard brokerage account. But it is absolutely crucial to note that not all ETFs are simple, safe little baskets. You've got these highly complex products out there, like leveraged and inverse ETFs, which rely on some intense financial engineering. They use debt, derivatives like options or futures contracts, and equity swaps to literally multiply daily returns, say aiming for double or triple the return of the S&P 500. Inverse ETFs use those same tools to actually profit when the market drops. But because these require daily rebalancing, selling after losses, buying after gains, they suffer from something called a volatility tax. Basically, their value degrades over time in choppy markets. So yeah, this significantly amplifies your risk and strays way, way far from traditional passive investing. All right, on to Section 3, comparing investment vehicles. When we really stack these vehicles up against each other, it becomes crystal clear why ETFs have just exploded in popularity. Think about mutual funds. They pull money, sure, but they can only be bought or sold once a day at a set net asset value after the market closes. ETFs, on the other hand, offer the exact intraday trading flexibility of an individual stock. You can buy them at 10 a.m., sell them at 2 p.m., whatever you want. And the pricing is dynamic, meaning ETFs can actually trade at a slight premium or loss compared to the actual net asset value of their underlying holdings. Plus, a huge perk. While mutual funds often drag you down with heavier management fees, ETFs are generally much cheaper to operate, especially the passive ones, and you can often trade them totally commission-free. But here is the absolute clincher: tax efficiency. ETFs act as a built-in structural shield. See, when you want to sell your ETF shares, you just sell them to another investor on the secondary market, the stock exchange. Because of that, the ETF sponsor doesn't have to go and sell off the underlying assets just to hand you your cash. By contrast, when you sell mutual fund shares, you are selling them directly back to the fund itself. The fund might actually have to sell off profitable stocks to pay you out. And guess what? That triggers a capital gains tax liability that gets passed right along to all the remaining shareholders in that mutual fund. ETFs neatly sidestep that whole mess. Let's lift the hood for Section 4, how ETF creation works. The absolute secret sauce of the ETF structure relies entirely on these entities known as authorized participants, or APs. These are massive, highly specialized institutional investors or broker-dealers. They act as the vital bridge between the ETF sponsor and the open market, and they regulate the supply of shares to ensure the whole machine runs smoothly. Okay, so let's dive into how this actually works, starting with creation. Let's say demand for an S&P 500 ETF is super high. The AP steps right in. They go into the market and buy up the actual underlying stocks of the S&P 500 in their exact right proportions. Then, the AP takes this massive block of stocks, hands it over to the ETF sponsor in an in-kind exchange. And in return, the sponsor gives the AP a bulk block of newly minted ETF shares. We're talking typically around 50,000 shares at a time, which is called a creation unit. Finally, the AP takes these brand new ETF shares and supplies them to everyday investors on the open market. Conversely, we have the redemption process. If there are just way too many ETF shares floating around on the market and the price is dropping, the AP steps in and does the exact reverse. They'll buy up the excess ETF shares from the open market, hand those shares back to the ETF sponsor, and in return, the sponsor gives the AP the underlying individual stocks. The AP can then turn around and sell those individual stocks. This process literally destroys or redeems the ETF shares, which effectively reduces the total supply of the ETF out there in the market. And the real magic making all of this work is the arbitrage mechanism. Look, authorized participants are always looking to scrape a tiny profit. So if an ETF is trading at a premium, meaning the ETF actually costs more than the stocks inside it, the AP is going to create more shares to capture that profit. That increases the supply and drives the ETF price back down. On the flip side, if the ETF is trading at a discount, they'll redeem shares, which reduces the supply and drives the price back up. This constant back-and-forth creation and redemption activity is what ensures the ETF's share price almost never drifts very far from the true net asset value of the assets it's holding. It is beautifully efficient. Bringing it home with Section 5, pros, cons, and investing. Look, the advantages of ETFs are pretty hard to ignore. They give you this incredibly affordable, super easy way to get immediate exposure to a ton of different stocks. You get instant risk management through diversification, and usually with exceptionally low expense ratios since most passively track an index. But you do need to be cautious. If you opt for actively managed ETFs, you're definitely going to face higher fees. And if you go with a single industry or highly concentrated ETF, like one where half the assets are locked up in just 2 or 3 companies, you are severely limiting that diversification we just talked about. Plus, some of those super niche ETFs suffer from a lack of liquidity, which can make it a real headache to actually buy and sell them when you want to. Despite the risks, accessibility is easily one of their greatest strengths. Because they trade exactly like stocks, retail investors like you and me can easily plug these funds right into our portfolios. You can buy them through traditional broker-dealers, online platforms, directly inside your retirement accounts, or even through automated robo-advisors like Betterment and Wealthfront. And honestly, the best part? Most modern investing apps offer zero commission trading on these assets now, meaning you don't have to pay a single dime in transaction fees to get in on the action. Which leaves us with a final, provocative thought to chew on. The ETFs started back in the 1990s as this beautifully simple, passive way to track a broad, reliable index. But today, with financial engineering pumping out complex, leveraged mechanisms and products holding incredibly volatile assets like cryptocurrency, the whole landscape is shifting under our feet. As the ETF evolves from a straightforward index tracker into a vessel for complex derivatives and digital currencies, we really have to ask, will this basket of securities remain the safe, reliable foundation for the everyday investor, or is the very definition of an ETF evolving into something far more unpredictable? Thank you so much for joining us on this explainer. Keep learning, keep questioning, and we'll catch you next time.